FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz. It's the last day of July 2018. Time goes quickly. Hey, as always, make my day. Send me an email, kl@kerrylutz.com. Person you're about to hear from, interesting person, interesting background, very unusual in the resource market. His name, Sam Broom. And Sam, you are a geologist and a broker at Sprott Global, working alongside our good friend Rick Rule. Welcome to the show.
Kerry, thanks for having me here. I'm excited.
So, met you in Vancouver for the Sprott conference a couple of weeks ago. Hard to believe it's already 2 weeks have gone by. Hey, a lot of companies there, but a lot of people kind of down in the dumps wondering if the miners will ever come back, whether this is the permanent state of affairs and we're just going to see low resource prices and get used to it.
Yeah, it's been a tough, really, the last 3 or 4 months, really. It's an interesting time for sure. As a contrarian, I'm personally very excited about the current setup, but it does take that contrarian mindset to look at the current situation and feel positive. It's always easy to talk about, but it's harder to put into action. Actually, taking advantage of these times in the market. Depending on where you look. I know a lot of your listeners are probably into the gold space. If you look at things like the Commitment of Traders report, which I'll give you a chart afterwards, Kerry, to put up alongside this chat, you'll look that currently the setup is about as contrarianly bullish as it's been in the history of the modern day Commitment of Traders report. So what you will see is that the net speculative positioning is as short as it's ever been in the history of the Commitment of Traders report. Let me just repeat that for you. It is speculators are the most short that they've ever been in the history of the Commitment of Traders report. So I personally don't ascribe all that much value to the Commitment of Traders reports and market positioning, except for when it is at extremes. And right now it is certainly at an extreme. So on that data point alone, I think it's a very interesting time to be keeping an eye on the gold space in particular. It's not just the gold space, though. If you go and look at things like the copper positioning, we've seen a massive, massive swing in market positioning from being at record net longs to almost not quite record net shorts, but very, very short in the space of about 2 or 3 months, which has been quite spectacular to watch. So from that perspective alone, it's if you're at least if you're a trader or a sort of a short to mid-term investor looking for opportunities, now is about as ripe of a position in terms of market setup as I have seen since I've been at Sprott. Just for some background, I joined Sprott in early 2016, having spent many years working in the Australian mining sector as a geologist. So, look, from my perspective, it's certainly been tough the last few months, but the current setup, from a tactical positioning standpoint, is about as exciting to me as I've seen, in my time on the financial side of things.
And good point. So the speculators, they're short big time. What about the commercials? So obviously they're taking the other side of the trade, right?
Well, yes. So you very rarely, if ever, see the commercials long. It's just not the way the market works. But they have been covering their positions at a rate of knots in the last couple of months. You can see that probably on the chart that hopefully we have up by the time we put this together. So they're at about levels that they were roughly late in 2015. Again, we're talking about the gold space here. So we all know what happened over the first sort of 6 months of 2016. That was a pretty fun time with things like the GDX going up well over 120. I think it was almost 130% peak, trough to peak at one stage there. So, look, I'm not saying we're going to have that kind of rally off the lows here, but the conditions are certainly there for something like that to be possible. That's kind of more from a trading sort of standpoint or a tactical standpoint. If you want to take a slightly longer term view and you want to look at more of the fundamentals, the mining sector itself is currently in much better state than it was. It's in a much better state than it has been for a long time. During the bull market from say 2001 through to 2012, I'm talking again about the gold market here, but it's more or less the same with the base metals and energy players as well. They basically drank the Kool-Aid and thought the good times were never going to end, and a lot of them way over leveraged. Made terrible acquisitions at exactly the wrong point in the market. They just never thought commodity prices were going to go down. China was going to keep growing ad infinitum. Demand was going to continue to go through the roof. And essentially, they must have thought that the cyclical nature of the commodity markets was done, and we were going to be in this forever bull market in commodity prices. So a lot of dumb decisions were made, and obviously, the commodity prices didn't continue to rise forever. Supply came onto the market, and prices took a massive dive. And we had what's been a fairly brutal, if not the worst, one of the worst bear markets on record in modern history for commodities, in particular the miners. The benefit of that is we've now had about, depending on which commodity you're looking at, anywhere between 5 to 10 years worth of serious pain and necessary deleveraging of the industry. So what we're left with today is a much more healthy mining, set of mining companies. Not the ones that remain are in much better financial health. They're much better set up to weather fluctuations in commodity prices. And if you know what you're looking for, a lot of them are even producing free cash flow, which is kind of crazy. That hasn't happened for a long time. And you're starting to see pockets of the sector outperform. I mean, for example, clients of mine will know that I've been a big fan of the Australian mining, the gold miners for a long time now. And again, if you bring up a chart of the ASX All Ordinaries Gold Index, you'll see how well that is done, in large part because of operational excellence by the companies there. They're all, well, not all, but a lot of the companies in that index are net cash. They got rid of all their debt and they now have hundreds of millions in cash. They're generating cash quarter in, quarter out. So they're actually, good businesses. So what they don't have, and this is what I think is going to drive the next bull market in the commodity space, is a lot of them, while they were deleveraging, which is a good thing in some regards, in a lot of regards, they were cutting back on non-essential costs, things like exploration and development. So what we're seeing now is there's absolutely nothing in the pipeline for just about every single company out there. There are exceptions and there are a few exciting new discoveries, but by and large, there's not a lot in the pipeline. All these majors, the major miners in particular, are staring down the barrel of a decreasing production profile. So I think what we're going to see, maybe not imminently, but over the next few years emerge is a supply side bull market. And those, if people have looked at the difference between a demand versus supply side led bull market, the supply side bull markets tend to be much more prolonged because it takes 5 to 10 years to really make it, from a time a new discovery is made before it becomes into production. So look, I'm quite excited. It's tough now, but I'm seeing major mining companies in much better financial condition, and I'm seeing the right ingredients for supply destruction leading to a really significant and sustained bull market.
Well, hey, and you might very well be in the minority there, Sam. But hey, having the geologist background, so I'm sure when you started out, the last thing you expected was being behind the desk in a brokerage, right? And yet here you are, but that's got to give you certain advantages and certain, I guess, certain insights that really aren't available to the typical broker over at Sprott or the typical resource investor. So putting on your geologist hat, because you know the business from the operations side, if you're running a company that sees its reserves kind of rapidly being depleted, what are you supposed to do? You're probably going to start buying, aren't you?
Well, and that's a big reason why at the moment I am extremely interested in looking for potential takeover candidates, because I think we're going to see a big ramp up in M&A, mergers and acquisitions throughout the mining sector. I think we've already started to see that happen. There's been 3 major acquisitions that I've seen in the last month or two. We had Dalradian, we had Arizona Mining, and at the moment we've got the Nevsun takeover in play. So 3 names in a matter of sort of 2 months. I think that's the absolute tip of the iceberg, because if you're a major miner or even a mid-sized miner and you're staring down the barrel of, say 5 years out, you're looking at a rapidly decreasing production profile, you've either got 2 options. You go out and you spend a bucket load of money on exploration. You need to have, the expertise to do that. And a lot of companies shed their entire exploration teams during the bear market. I mean, I saw that firsthand in Australia, where one day you go out to site and half your exploration team's been sent home on a plane and, goodbye, sorry, we don't have any money for exploration anymore. So most companies don't have these teams. Sorry, were you going to say something there?
Oh, no, I'm just agreeing with you that they've kind of cut to the bone, counting paper clips. That companies do this when they all of a sudden are confronted with hard times that they never foresaw coming. When they go from boom to bust, then all of a sudden everything is expendable.
Exactly, and it's exactly right. It's the non-essentials that go first. And when you're in a whole heap of trouble and you got debt coming out your ears, exploration's the last thing on your mind. So that whole team goes away. So not only do you have to ramp up your exploration, you have to hire your entire team back, or at least the majority of it. So look, a lot of these companies just don't have the capacity to do their own exploration anymore. So that leaves you with either a declining production profile, or you have to go out and look at projects that you can acquire. And that's also a lot quicker. I mean, if someone's already done the hard yards of spending 2 or 3 years making a discovery and drilling it out, getting it to either feasibility stage or something around there, or maybe even in development, that's what you're left with. And I think we're getting very close to that M&A part of the cycle heating up. And the beauty for producers is right now valuations are at historic lows. If you look at just about any metric, and they all have their imperfections. So you never want to rely on one key metric, sure. But things like the enterprise value per ounce of gold, and a discovery and things like that. You'll see that valuations right now are very cheap compared to historical norms. So there are companies that have deposits that they can buy at attractive prices right now, and that's a rare thing. And so we usually see 2 waves of M&A throughout a cycle. You'll get the kind of savvy buyers that come in early, and we saw a bunch of that happening in late 2015. Things like M&amp getting bought out, or
right.
There are a couple of examples of that which I would describe as savvy buying at the lows type of thing. Then you get the second wave of M&A later in the cycle, which I'd call the dumb M&A, where you get the mega projects that get bought out for billions and billions of dollars. But right now we're firmly in that savvy M&A phase where I think we're going to get to see the few really decent either top tier 2 or the very few tier 1 deposits. I think they're going to get snapped up, and it's quite. I'm not going to say it's easy pickings, because there's a lot that goes into it, but there just isn't that many high quality projects out there to choose from. So if you know what you're looking for, you probably got somewhere between 5 and 10 projects max in any commodity that are potential M&A targets. So sure. you do your homework, you find those, you take a position when things are down. I think you're going to do pretty well over the next 12 to 18 months.
Yeah, that would make sense. And yeah, how many sectors in the market is there really value that is just out there waiting? And you got that situation where these big companies, if they don't make acquisitions, they're basically going to be out of business. So that is a big factor there, no doubt. So it's obviously a good place to be right now, but you have to be careful, don't you? What do you have to look for in a company that's most important?
Right, you do. I would say commodity-wise, just about every commodity, is pretty depressed at the moment. Gold's fairly depressed. Uranium's extremely depressed. Copper's, it's not as depressed, but there's probably the one where there's the absolute least amount of development stage projects to buy. Look, I think there are reasonable opportunities across the full spectrum. In terms of what to look for, stick with absolute quality. You can do what you want, but I personally look for deposits that I would describe as either the high end of the tier 2 deposits. And I look at those simply because there just aren't that many tier 1 deposits. I mean, they're as rare as hen's teeth. They just don't exist. They just haven't been found recently. So it forces you to look down to those sort of high quality tier 2s, which are usually not mega mines. They're not 20 million ounce gold deposits, but they're sort of, to use the gold analogy, somewhere between 2.5 and 5-6 million ounce type size. They're going to be high margin mines, they're going to be attractive to a mid-tier or even a small major.
Sure.
Stick to the quality. High grade's always good, but there are other things as well. You want to look at, strip ratios and, how hard's the rock and how much energy is it going to require to break it up? Is it in a safe geopolitical jurisdiction? Things like that. There are a whole lot of different criteria you need to look at to evaluate these things. But, if you get a list of, say, 5 to 10 criteria that you're looking at and you whittle down 5 to 10 of the best targets in each commodity category, take a position in those things, sit and wait, and I think you'll be pretty happy over the next 12 to 18 months. You'll
potentially be richly rewarded, right?
That's the idea. So, look, it's a game I've been playing since I got here at Sprott, and we largely do a lot of it at Sprott. And personally, for me and my clients, I'd say it's probably been one of the more prosperous, methods of investing, particularly in a bear market, like we've been having. It's when the tide's rising, it's a fun place to be pretty much everywhere. But when we've been in a flat to sideways market like we've been, a flat to down market, I should say. You really need those catalyst-rich stories or investments to go into, and the takeover approach is one that works almost as well in a bear market as it does in a bull market, as long as you get the timing and the valuation right.
Mm-hmm. So contrarianism pays, but you have to know what you're doing. You can't just bet against a market because it's down. You got to bet for a market because it's down and it's going up.
Correct. Yep. And you need to be very selective with what you do within that market, because you can cover up a lot of, or you can you can deal with a lot of negativity within a sector if you buy the right type of assets at the right time. I mean, buying quality when prices are down, there's no better way to make money than buying quality assets when they're on sale. It's the Warren Buffett mantra, right? You want to buy quality things when everyone else hates them. And at the moment, there's gifts out there all over the place.
Yeah, or run into the market when there's blood in the streets.
Exactly.
Also one of my favorites, and certainly in this sector, there's quite a bit of blood, and
she's pretty red out there in the streets right now. That's for sure.
Oh goodness, yeah. So, well, without bothering to ask you particular stocks, we'll put the COT chart into the show notes in this interview. People want to reach you or reach out to you. Where do they go?
So the best way is probably to send me an email. My email is sbroom, so SBROOM @sprottglobal.com. You can also follow me on Twitter as well. My Twitter handle is @TheNudeInvestor. So it's a little hang up from my blogging days. I used to have a blog called The Nude Investor. But if you want my insights, it's probably a good place to get those as well.
All right. Well, I think you can definitely profit by following Sam's advice, because I always like it when people know the business, both under the ground and above the ground. I think it's very important because that's how you kind of pick the winners. It's one thing to know the sector is going to go up and have your feelings about it. Another thing altogether to be able to pinpoint those companies who might be able to profit most from it. So, Sam, really appreciate you coming on. We will talk to you again. We'll have a link to Sam's email address in the show notes to this interview as well. Be a part of the show. Send your questions, comments to kl@kerrylutz.com. Check out the Twitter feed @KerryLutz and the Facebook page, Financial Survival Network, of course. And Sam, we'll talk to you again real soon, and let's all buckle our seatbelts.
Thanks, Kerry. It's been a pleasure.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.